is Monday, April 29th, 2019. It is 8 p.m. Pacific Standard Time, and so you know what time it is. It's time for a little bit of coin metal. And it was a double duty. Get your ass kicked at Jiu-Jitsu Monday. I'll tell you what, 2-a-days, and kind of for the birds. I got up really early, and it was one of those times when I didn't actually get up on time for the 6 o'clock class, but I did get up before 6 o'clock, so I said, fuck it, it's an open mat, so I'm going to get my ass to Jiu-Jitsu. And so, it was, again, it was one of those things where I'd already been victorious in the biggest battle, which for me, at that time in the morning, is just getting out of bed. And I stayed awake, which is the second part of the battle. But third, most importantly, I actually made it out the door and to Jiu-Jitsu. And it was a pretty productive morning, I felt. Although I really couldn't tell you what we were doing. It seemed like we were working some stuff from the previous week of classes. And so a little bit of drilling mostly. But of course, me with one of my training partners, it would always evolve a step or two past the move that we were intending to do. And I don't know if that was because he's adjusting or I'm adjusting or we're both adjusting or something's going on there that it casually escalates until one of us gives up. And, tries to get back on track with the training session, But, I felt it was productive, just in getting out and doing it, And it's always really good to have the main instructor there on the Monday class. It kind of sets a good tone for me. But altogether, I do feel like my jiu-jitsu is kind of stuck in one or two places, but progressing in others. I think I know I've noted multiple times on the show that trying to progress with higher belt people has been my main goal as of late, and I feel like that kind of paid off today, because I don't think I rolled with a single person that was under a blue belt, and most of them were purple, brown, and black belt. So, yeah, like I said, I've been trying to take that self-imposed challenge a little seriously, and pushing the envelope on the skill set of the people that I'm dealing with. Unfortunately, on the last round that we were doing today, it was we were trying to do takedowns, and the drill was that you would have one person offensive, one person defensive, and takedowns was just it. So you take your opponent down, then you get back up, slap hands, start again, standing, and then go to a takedown again, if you can. And I was pretty stout in avoiding being taken down by my opponent, although he did take me down a few times. My biggest trouble was I think I had two legit quote-unquote takedowns. The rest of the time that I actually got him off of his feet, I was pulling guard. And that really wasn't the assignment, and I was just having a lot of trouble. Number one, he's quite a bit more skilled than I am, but I'm not trying to use that as an excuse. I'm just saying the guy was pretty skilled, keeping his feet out of the way, and he was taking it easy too. And that's what bugged me the most about it, is I could feel it from his energy that he was taking it easy on defense, and he was still managing to avoid me. So it's definitely something I'm going to have to spend a lot of time working on. I can't put that one on anybody else. The lack of training is certainly all mine. But like I said, I really have been trying to get in as much time in jiu-jitsu as I possibly can in the last few weeks. I think I had 1 week in the last probably 3 months where I'd only been to jiu-jitsu 5 times a week. And so, it's not that I'm not putting in the time. I'm sure it's because I'm a little bit older and it's a little bit tougher for me to get the stuff stuck in the old noodle. But nonetheless, it's a lot of fun and it's great exercise. I don't think I've been in this great a shape in a long time. As a matter of fact, I know I haven't. And that's probably one of the best takeaways at this point. That and being a little more confident and certainly pushing for a little more perfection in everything I do. That's like the reward of it, I think, is the push towards excellence. The path of jiu-jitsu, it has many side benefits, and one of them is wanting to do everything at least as well as you do jiu-jitsu. Anyway, let's go ahead and throw down into some music, and I haven't played this in a while, so here it is. Body Count, First Dance, The Ski Mask Way, here on Coin Metal. And that was Meshuggah with Concatenation. As far as where we're going to go today, got all kinds of stuff here. Been trying to narrow it down to a specific topic at least, and that's proving to be a little bit challenging on this Monday, but I'm going to give it a go anyway. And I got this first article here on fortune.com. NYSE owner buys crypto custodian in latest push to offer Bitcoin. Backed. Anyway, this is authored by Jeff John Roberts, 11 a.m. EDT. So yes, penis. Intercontinental Exchange, which owns the New York Stock Exchange, made a splash last August with big plans to get into the Bitcoin business. Those ambitions, however, have been stymied by regulatory delays, leading ICE on Monday to announce a series of measures to jumpstart its efforts. Most notably, ICE has acquired a crypto custodian service called Digital Asset Custody Company and arranged for its cryptocurrency subsidiary known as Bakkt to become a registered trust within the state of New York. These measures are intended to clear the way for ICE to offer Bitcoin futures contracts that settle in Bitcoin rather than cash. Such contracts have yet to materialize, in large part because the Commodities Futures Trading Commission objected to an earlier plan by Bakkt to, quote, warehouse physical Bitcoin. If New York grants Bakkt's application to operate as a trust, ICE will have the status of a, quote, qualified custodian, which will remove legal obstacles to holding cryptocurrency assets tied to futures contracts. According to Kelly Loeffler, CEO of Bakkt, the company is not changing strategy but is instead clarifying its role in the larger world of crypto trading. Quote, there is no pivot. From the ground up, what ICE has been building for 2 years is the safest version of a custody solution for digital assets, she told Fortune. Adam White, Bakkt's chief operating officer, added that the company's focus has not been directed at building an exchange as some have assumed. Instead, he says Bakkt's technology efforts have been directed at security measures to safeguard customers' assets. White also claims that Bakkt's technical and legal safeguards will persuade large institutional investors to add cryptocurrency to their portfolios. For practical purposes, the company hopes the investors will use other ICE services, namely its futures exchange and its clearinghouse, alongside its custody offerings in order to purchase crypto. Bakkt, which has raised $182.5 million from ICE and strategic investors like Microsoft's venture arm and Boston Consulting Group, did not disclose how much it paid for the New Jersey-based digital asset custody company, but it stated it would retain the CEO and all of its employees. ICE's emphasis on custody comes at a time when the number of established cryptocurrency companies, including Coinbase and Circle, are offering similar services to safeguard customer assets. It is unclear if the offerings will persuade many institutional investors, including pension funds, to take the leap into crypto, or which service they would select for custody. White claims ICE's familiar brand, combined with the ability to buy futures contracts that settle in Bitcoin, will spur institutional interest in cryptocurrency. He added, at a time when the vast majority of Bitcoin trading volume is reportedly faked, the futures contracts will also serve as a signal into Bitcoin's true price. It'll be way more expensive. In recent weeks, Bitcoin has been consistently trading above $5,000, which some see as a signal the market is coming out of a long-running, quote, crypto winter that followed the bubble of 2017. While ICE's custody plans could spur increased trading in the crypto markets, the company in the meantime must wait for New York regulators to approve its application to become a trust, a process that could take months. Despite the delays, ICE is pursuing the grander ambitions that it announced last summer. Specifically, Monday's announcement reiterated an earlier pledge to one day use blockchain to, quote, enable faster, less costly, and more efficient payments for companies like Starbucks. I don't know what's wrong with these people. Apparently they don't read white papers. What's one of the biggest features about Bitcoin? Can you think of it? I can. It's digital assets that you yourself can hold. You don't actually need another custodian to hold it for you. And this is a point I think that many projects actually fail on when it comes to their conceptualization of what they're doing here, what they're actually doing in crypto. And I've predicted many times that if Bakkt ever launches, they are going to lose money. Period. I don't care. I mean, there are certain issues with trying to exchange between Bitcoin and fiat. And for one thing, you can only do it on spot. You can only do it like right now. And it's because you can take possession of the Bitcoin right now. And the price is always changing. So trying to account for any real fluctuations in the price and selling futures contracts that will actually pay out in Bitcoin, I think that they're going to find that whales will manipulate the shit out of the price because they know the cashed out date for whatever contracts that ICE is running, and they'll be looking to wreck these people. About a week before the cash out, they'll sell or something like that, sell really hard into the market, and then you're completely fucked. Or, you might get lucky and hook up with it on a time when it's actually going up, or at least is profitable over what you originally had bought it for. And I don't know, we've seen this again and again, where institutional investors have tried to put their feet in just the investment end of it. They're not putting their real skin in the game. Where, I mean, if Bakkt was really serious, they would take that $182 million and they would buy miners with it. That's right, they would buy miners. And then they could sell futures contract based on their expected yield. Now, whether or not they'd actually achieve their expected yield is a whole different thing. But the yield, they're talking about wanting to cash out in Bitcoin to their customers. Well, there you go, man. You mine it and then you sell it at whatever price you want to. Now, if they did do it that way, I predict that we would see a much higher price for Bitcoin. Because all of a sudden an institutional investor that has to account for every fucking dime that they invest is going to be looking at mining in terms of trying to make a profit on it. And so they're not going to be selling their Bitcoin at a loss up front just to get investors in the door. They're going to be looking at the projected yield, and they're going to be determining their price according to that. And of course, they'll have to take into account any bumps in the amount of miners being sold or miners coming online that were previously boxed or whatever. But those are the things that make the market that much more difficult to account for, is that you, behind your computer right now, you could be dedicating some hardware and some bandwidth and some electricity to mining a cryptocurrency. And that's completely unaccountable. You know, you can't look at the hash chart and say, oh, okay, in about 5 hours, little Timmy is finally going to make the decision to turn on the miners that he's had sitting in his closet for the last 3 months, and the hash power is going to come on, and then the difficulty is going to adjust by this much. You can't do it. I mean, unless you're reading little Timmy's mind all the time, which I don't think we're actually capable of doing, even with all the computers around us. But nonetheless, you can't really account for those kind of things. And there are jurisdictions that even if you were monitoring little Timmy's every little thought, there would be somebody out there that you're not monitoring, that you can't account for, that is going to bring some hardware online, and is going to throw that difficulty adjustment up. That's all there is to it. It's the nature of the game. So ICE, trying to stay on the sidelines and just buy the Bitcoin and then sell the Bitcoin and then buy the... they're going to end up getting wrecked. If they ever come to fruition, they're going to get wrecked. I mean, Novogratz, that guy's got I don't know how many years on Wall Street, but he's lost like $180 million on his investment plan. Like his little hedge fund that he had going, he's losing his ass on it. This is a guy with plenty of market experience, plenty of experience with regulators and taxes and all that other business, and he's getting wrecked. I think one of the biggest problems with crypto is that the expense structure is way different than any other business. And so when you're trying to account for adjustments in it, it's not really possible in the same way that it was with legacy finance. I mean, because in legacy finance you have a single issuer. Ultimately, you have a bank. And again, in Bitcoin, you can be your own bank. You can be the one that's holding on to your funds. And nobody can loan out any money against your funds. Nobody else has any custody or access to it. At least not without hacking it. But the point being is it's not in anybody else's hands. And so nobody else can account for it. They can't account for when you're going to sell it. They can't account for when you want to buy more of it. They can't account for these things. And so trying to act as some sort of intermediary, I think invariably it's going to get people wrecked. And I don't care about your experience, I don't care about your market connection, and I don't even care about your perception of how much regulatory clarity there should be in this space. The fact remains that you don't have to be here. You don't have to be in crypto. At least most of you don't. Some of you do, though. Some of you really have no choice in the matter, that it's the only way that you can earn enough money to stay alive. Because other means of earning money tax you too hard. Too much of the money that you're working for is ending up in somebody else's hand before it gets in your hands. I mean, it really doesn't take too much brain power to figure that one out. That, between Social Security and all the little taxes they nick you for out of your paycheck, and then also all the little taxes that they nick you for in all of the little things that you buy, I mean, you can't really get ahead if you're having to endure all of that additional friction on your transactions. We're not made of money, and it's something legislators keep forgetting. When they're writing up legislation, and we'll add 10 cents to fishing licenses, or we'll add another 5 cents to cigarette taxes, or something like that. It's like, hey, you're probably getting like most of our operating capital in taxes as is. There's going to become a point where we're not able to buy things. We're having to make shit. And so all the economic activity from us buying things goes away. All the little points where you could tax us on that economic activity goes away too. There's only so much money in the pot. And just because you tax it more doesn't create more. It just increases the price of everything. Anyway, I got this next one in. I had intended on getting to this one, but for some reason I never got around to it. Anyway, it's on BitcoinWarrior.net. Bitcoin enthusiasts debate cryptocurrency's block size, address censorship concerns. Gosh, that's a discussion we've been waiting for a while, huh? And this is it was authored on April 27th, 2019, and no attribution of who wrote it. Let's check and verify something. Let's see if we can find the original source. AMB Crypto. Close that. Let me see if I can find like the original one. I guess this is the original one. And so this is on AMB Crypto. And Bitcoin enthusiasts debate cryptocurrency's block size, address censorship concerns. And this is by Namrata Shukla. No penis. Kind of hot looking from this picture. Anyway, this is published 4 days ago, April 26th, 2019. Here we go. The cryptocurrency community is looking forward to Bitcoin reaching its glory days as expectations of a bull run strengthen. However, there is an ongoing conversation among Bitcoiners about the block size of the coin. Twitter user @CobraBitcoin, co-owner of Bitcoin.org and BitcoinTalk.org, shed some light on the issue by talking about increasing the block size of Bitcoin to support Lightning function. However, he also pointed out a looming problem in the community. Quote, "The reality, Bitcoin's block size eventually needs to be increased as even Lightning can't function with high fees. The problem, a good chunk of the community has ideologically trapped itself into a small block mentality and will find it difficult to crawl out." Yeah, but eventually you do have to admit that it's pretty stupid. Anyway, continuing. The user countered that Bitcoin enthusiasts who argued that Bitcoin did not exist to serve Lightning, to which Cobra Bitcoin responded by stating that the use of the coin is to enable people to transact without large fees. He added, quote, "If we get to a point where high fees are consistent, Bitcoin will be upgraded to bigger blocks." No, they won't. No, it won't. Bitcoin enthusiasts also brought up the risks associated with increased block size, such as censorship. And Jordan BTC Please said, or PLZ Please, quote, "Speak for yourself, abhorrent fees are much more acceptable to me than any incremental risk of censorship or confiscation." You know what, dude? I don't know where your brain is, Jordan. But increasing the block size does not increase the risk of censorship or confiscation. Continuing, initially Bitcoin's block size was limited by the number of database locks that was required to process it, and this limit was around 500 to 750K in serialized bytes. However, the explicit size of 1 megabyte was introduced in 2010 by Satoshi Nakamoto, the creator of Bitcoin. The conflict over increased block size mainly revolves around the security part of Bitcoin, and an increased block size could lead to major security concerns. No, it can't. Look, many people have been talking about this, and there's been a lot of FUD put around the idea of increasing the block size. And I say it's FUD because Bitcoin Cash has already proven that increased block size does not, in fact, increase the possibility of being censored. It does increase centralization, but only in the fact that it's not Bitcoin that's doing it. If Bitcoin had 32 megabyte blocks, it would be filling like 4 to 8 megabytes consistently. And because there would be so much additional block space, it would be cheaper per transaction. And we would see more transactions. And this is something that the people that have been talking about 1 megabyte blocks, they just don't understand about mining. If you increase the incentive, more people will mine. If more people mine, this increases the security of the network. Anyway, the 1 megabyte block size limit, the reason why it is, I feel anyway, the reason why it is such a contentious point is that the 1 megabyte limit is meant to extort most of us off of the network. It is meant to make it too expensive for you to do anything with it without a third party involved. These people that are saying, oh yeah, go ahead, high fees, they don't understand. They weren't here for $50 transaction fees. They weren't here for that. If they were here for that, they would understand two things. Number one, the concerns about all of the traffic on the volume of the trading going on with Bitcoin being fraudulent. Those would go away. Because the first thing you'd want to do is look back at what the previous chart said as far as how much people were paying for fees and how many transactions were going on the network. And if you look back to that time when we were paying outrageous fucking transaction fees and we were held up for hours, if not days, before we got a first confirmation, look at that fucking chart for the transaction volume that was going on. There's this huge fucking mountain, okay? And that means there were that many more people trying to get their transactions completed than at any other time. And that's why that block space got so scarce that people were having to pay $50 to get their transaction included in a block. Now, extend that forward, okay, where we are going to go back to where we're paying that much. They made some sort of math adjustment with regard to the fee estimation. And so right now, I think anyway, people are paying unfairly cheap fees for transactions. That the math has been monkeyed around to keep people kind of tantalized with Bitcoin. That eventually, when it does go up, say another $1,000, that's going to make that fee jump by 10 times. That's what it did last time. When it went from 4,000 to 4,000 to 5,000 or 3,000 to 4,000. I want to say before it hit 5,000 the first time, the fees jumped from 20 cents on average to $2 on average. And that was just $1,000 movement. Now imagine you've got another $1,000 movement on top of that. So we're back up to $6,000 per Bitcoin. Now we're going to be paying $20 transaction fees. Alright, think about that one a little bit. $20 to get a transaction included in a block. That immediately opens up the fact that if you are going to start a payment channel, you're not going to be doing it for less than $100. Because before you know it, when it goes up to $8,000 a Bitcoin, if you had anything less than like $100, maybe $200 on your node, it just got turned to dust. Because now the transaction fee is more than you've got on your fucking node. And I mean, sure, it'll go up a little bit in value, but like I said, from 3,000 to 4,000, it jumped from 20 cents to $2. It goes up to $6,000 from where we're at now, and I think we're at like $2 again for transaction fees. I haven't checked it in a little bit, but the fact of the matter is it'll jump again, and it might be $20 for a transaction fee at $6,000 of Bitcoin. And if that's the case, you're going to see a lot of these people that are supporting Lightning right now, they're going to switch really quick to the big block side of the debate. I've always argued that Lightning is not meant for casual users. It is not meant for you and me. It is meant for big fucking banks that need to move around a lot of fucking liquidity really fucking quick. And they intend to be managing transactions for thousands, if not millions of users in their payment channels. And you can bet that because they're going to be talking about like millions, if not billions of dollars per transaction, that you're not going to be anywhere near it. Because they are not going to risk an adversarial node on the network sucking that liquidity out of their node. They're just not. Period. So yeah, I expect that between the increases in price and of course the increased demand for the block space, that we will see a vast increase in the price for transaction fees, and it is going to destroy the fantasy that we're going to be able to piggyback billions and billions and billions of transactions on our little Raspberry node fucking Lightning Network node. It's not going to happen. Anyway, let's go ahead and throw back down into some music. And I know that was just a little bit short on time as far as actual talk. I don't know. You know what? I want to do this one really quick before we get on there because it's right along what we were just talking about. This is on ambcrypto.com. Bitcoin crippling transaction fees poses a threat to crypto investments. This is published 5 hours ago on April 30th, 2019 by Arijit Sarkar. So yes, penis. Continuing on. Bitcoin is currently maneuvering a market controlled by the bears and has been consolidating its losses since a sudden collapse on April 25th. The largest digital asset even tested the $4,900 level prior to the forced correction, which recovered its value and pushed the coin's price above $5,000 and the $5,300 resistant levels. While Bitcoin strives to maintain stability in the middle of the crypto winter, the crypto ecosystem noted a steep increase in transaction fees, further threatening the user's return on investment in the volatile market. Consequently, prominent players such as Bitcoin Cash and Bitcoin SV gained loyalty within the community, owing to lower transaction fees and seemingly similar security. However, BTC claims the reason for higher fees is due to the increased focus on security and slower transactions. The issue is highlighted by Vladimir Weinbender, Woloja 1987 at Twitterati. Quote, BTC transaction fees have averaged $432,633 over the past month. They have averaged $314 for Bitcoin Cash and $125 for BSV. The initial tweet also explained how this would require 3.8 years for Bitcoin Cash and 9.5 years for Bitcoin SV to accrue the same amount of transaction fees to miners as Bitcoin does in one day. The tweet quickly gained traction and was flooded with replies that majorly supported BTC's decision. One of the more popular replies was from Ceteris Paribus, who said, quote, for a good store value like BTC, I am willing to pay more in fees. For a medium of exchange like BCH, I am not. As a matter of fact, H. Lopez rightly pointed out that BTC, like today's BCH and BSV, was also unprofitable to mine at one point when it lacked real-world use cases. Yeah. Well, I think that what we're going to see in the not so distant future is that, yes, the coders for Bitcoin Core are going to stay intransigent and stuck with this 1 megabyte block size limit, and that what's going to happen is that when we do get up there in the $6,000 to $8,000 range, we are going to see another vast increase in the amount that it costs to do a transaction on the Bitcoin network. And when that does happen, we are going to see alt bloom 2.0, because people are going to create their own fucking cryptocurrencies to get around having to pay ass rape fees on the Bitcoin network. Security be damned. They just want to get their transaction done. They want to move monetary value from one person to another without the need for a bank, and they want to do it now, because that's what this technology is capable of doing. And pretending like it can't, and we have to settle for a settlement layer and do all of our transactions through Visa or MasterCard or one of those motherfuckers, it's bullshit. And in the longer term, because of crippling transaction fees, that's exactly where you're going to end up. You're going to end up with a third party who can actually afford to pay thousands of dollars for a transaction fee, because they're going to be doing millions, if not billions of dollars in that transaction worth of business on the Lightning Network for you. But all of the wonderful things that brought you to Bitcoin, all that transaction censorship resistance and all that other business, that all goes away. When you give your money to somebody else, all of that goes away. Anyway, like I said, let's go ahead and throw back down into some music. And where to go? Man, I got some Crowbar playing in the background. I really like Crowbar. But I'm feeling the need for some Metallica. And so here it is. Eye of the Beholder. Here on Coin Metal. And that was Overkill with Last Man Standing. I gotta tell you, I'm really enjoying that album, Wings of War. And that's like their latest release. And it's like, I don't know, there's always been like one little glitch or something with an Overkill song for me. Like they went just a little bit too far with something, you know, like the song was too long or something like that. And it's like they managed to polish their style up so much from all of their years of experience, and it's fluctuated, you know, like there's a few albums in the middle there where it was just like on, you know. But I gotta say, like Wings of War, it was like they took all of the good elements from all of their previous efforts, improved like 3 times on those, and then like went without just that one extra step or whatever that made it a little hokey or kind of campy, you know what I mean? Like I'm one of those people that I don't like British comedy. There's certain British comedy I like. I love British deadpan. But there's certain styles of jokes that I really don't like. And one of them that it's like Mr. Bean's bread and butter is continually doing the same thing over and over and over again. You know, it's like he'd do it, he'd get the laugh, and then he would do it again, and he'd get the laugh, and he would do it again, and again. And it was always just like 1 or 2 steps too many. You know, it's like he could have like trimmed it down just a little bit and gotten to the premise or the resolution of it a little quicker. But that's like a motif in certain British comedy that I've noted, and it's like I get bored after like 1 or 2. You know, it's like, come on, I want to get to it and move on. Anyway, as far as our subject matter, I got this next one here on BitcoinWarrior.net, and this one is it was authored 4/30/2019. So apparently a time traveler wrote this, and let's see if it refers us back to the original article. Yeah, here we go. That's one thing I don't like about that Bitcoin Warriors. Like, if it doesn't have an attribution on it, it's from another site. They give at least a URL for you to go to the original source. But yeah, anyway, it's on ambcrypto.com. Bitcoin Lightning Network adoption would improve if exchanges started using it between themselves, claims Drija. And one thing, Taj, Adam Back kind of screwed that up with Liquid, because that's what Liquid is supposed to do. It's a side chain between exchanges that they can do their own little transactions between one another, and none of us are privy to it. Anyway, and this one was authored April 29th, 2019. So approximately 11 hours ago by Birajmain Tamuli. And going from the picture and the name, I will say yes. Penis. Bitcoin's Lightning Network gained massive popularity in 2019, with statistics backing up this assumption after the Lightning Network recorded an impressive $5 million in capacity on the back of a recent price hike. Anton Gorodowski, my apologies, sir, a Bitcoin Lightning wallet developer, spoke about the LN in a recent interview, claiming that important updates were underway. These updates would improve the overall efficiency of the Lightning Network, he added. He also opined that LN was, quote, almost ready for extensive adoption after operating on the mainnet for more than 12 months. However, one of the important figures involved in the creation of the Lightning Network begged to differ. Taj Drija, the co-author of the Lightning Network white paper, recently appeared on What Bitcoin Did podcast and expressed his views on the Lightning Network. Taj said the Lightning Network was definitely on the mainnet in all true sense, but its functionality and operations were still very testnet-like. He highlighted the fact that people were not using it for real transactions, and the Lightning Network was hardly involved in people buying goods via this medium. He believed that Lightning Network could gain significant importance if implementation or adoption took place between exchanges. Taj Drija mentioned, quote, it will be really cool and safer, I feel, if exchanges like Coinbase, Gemini, Kraken are like we support Lightning and you can open a channel with us and send payment to us very quickly. If exchanges allowed users to deposit and withdraw via a created channel, and when the user were done trading, they could directly transfer their funds back to their side of the channel and use the LN, would be much more important in the cryptocurrency industry, he added. At press time, Lightning Network capacity was recorded at 1.057.98 BTC, which is approximately $5.5 million in valuation. I'm thinking that's 1,000.57 BC or 1,057.98 BTC. They put periods in there instead of fucking commas where it was supposed to be. So anyway, continuing. Which is approximately $5.5 million in valuation. It boasted around 8,197 nodes and 38,310 channels. Very, very interesting. Yeah, as far as that goes, I'd like to know who has what. How much of that 1,057 Bitcoin is held up in one person's nodes or one person's hub? You know, I've heard about a lot of concentration as far as that's concerned, you know, where there's a significant amount of Bitcoin being transacted between one entity's nodes or being held up in one person's payment channel. And I mean, at one point, the Lightning Network lost about 50% of its liquidity because the guy that was hosting this huge liquidity on this node, was looking at it and saying to himself, I'm hardly making any money on facilitating transactions, so I'm going to say no to having all this risk to somebody hacking my fucking node and stealing all my Bitcoin. So, anyway, as far as improvements on it and whatnot are concerned, like I said, you guys are basically beta testing this shit for Visa or MasterCard or, some huge payments processor that's not you. I've said multiple times that I think that all this layer 2 stuff is an industrial level use case application. It's not going to be something that the average newbie or whatever is doing. The intended structure of the network is not a bunch of mesh network nodes. No. It's concretized payment channels between the Bitcoin network and like Coinbase, Gemini, Kraken, Visa, MasterCard, the NSA. And it's funny because you've probably heard people talk about onion routing with regard to the Lightning Network and how that's supposed to obfuscate your transactions to where they're not censorable, right? So consider this: not only are you going to be giving or getting your money from Coinbase, Gemini, Kraken via this payment channel, you're also probably going to also have AML KYC with Coinbase, Gemini, Kraken, and so there goes all your obfuscation. And as far as censorship on your transactions, Coinbase, pardon me, if Coinbase is facilitating your transaction, they're the third-party arbiter that gets to say no. No, I don't want to let you do business with Delta Market and buying fucking PCP or psilocybin mushrooms or some shit like that. No, I don't want to let you do that because it's not legal in your country, and I want to be all compliant with your government, so no. And I think it's one of those points, and I should mention this, that one of the concerns, I guess, with Bittrex that the NYDFS used as an excuse to not give them a bit license was the fact that they had customers that had, I guess, some sort of links to darknet transactions, and so they're like, oh, you're money laundering for drug dealers. No, you're doing less than quote unquote legal in some jurisdictions commerce. That's all it is. I think in the longer term, when we're looking at the volume of commerce that's actually happening and the benefit that individuals have in their lifestyles due to being able to perform that commerce, we're going to see that the social good far outweighs the social bad of some individual using the substance. I mean, most people I know that use substances use them relatively safely, meaning that they're not smoking fucking DMT behind the wheel of their vehicle. They're just not. It's a fucking stupid idea, and they know it, and so they don't treat the drug like that. I know people that have driven while they're on like acid or something like that, and that's kind of scary. I mean, the idea of it. Not that I've ever done that, because I have not. Because I'm not stupid. I don't treat LSD like that. It's like if I'm going to do something like that, I'm going to be in a specific place for a specific duration of time longer than 8 hours. Because I'm not going to be driving anywhere. Man, that mic hits my tongue. Forget about it. Forget about it. I'm not driving anywhere. As a matter of fact, I'm not even riding with anybody. I am where I'm going to be for however long the trip is. And that's all there is to it. I mean, you want to kick me out of the venue or whatever, I'm going to have to go and hang out in my vehicle, but I'm certainly not going to be driving anywhere until that shit fades away. because I'm more responsible than that. I understand what the experience is. And I think that's something that a lot of regulators don't consider when we're talking about cryptocurrencies, is that the vast majority of people that are involved in cryptocurrencies, they're at least savvy enough to understand the type of investment and the types of risks that are involved. And if they're not, they deserve to get wrecked anyway, because they're just jumping into the pool without asking anybody what the rules are. You get drowned, sorry bro. You get wrecked, it happens. Even professionals get wrecked. A la Novogratz. Pardon me, I'm getting a little bit of a phlegm ball in my throat here. Get a sip of water. Yeah, I got one here. Hold on. No, I don't. I thought I did. I do. Thank goodness for the water container from jiu-jitsu class. Always available. Anywho, there's a couple other articles that I wanted to get to on this point. And I got this one right here. Moody's warns blockchain may pose systemic risk to structured finance. The rating agency welcomes potential efficiency gains but warns about concentration risk. This is by Ryan Weeks, updated April 29th, 2019 at 9:45 a.m. GMT. So yes, penis. The use of blockchain technology in certain complex financial markets could create a risk of systemic crisis, according to Moody's. In a new report, the rating agency highlights the growing attraction of blockchain technology, the software that underpins cryptocurrencies such as Bitcoin, to banks and others involved in so-called securitizations, or the conversion of debts and other financial assets into easily tradable forms. Blockchain technology, which creates electronic ledgers of transactions that can be shared easily among all parties to a trade, can make securitized trades more efficient and lucrative, Moody's said. However, senior analyst Frank Cervini stressed its use in securitization is still, quote, in a very early stage. However, its widespread adoption would also introduce new risks, the agency warned. The report's authors write, quote, new key transaction parties will be introduced to the process, namely the entities that serve as developer, provider, and operator of a blockchain. Quote, they may be either closely linked or identical with the originator or independent third-party service providers, which could lead to a certain degree of counterparty concentration risk. The authors go on to state that concentration risk, quote, may also assume a systemic component if multiple securitizations come to rely on the same blockchain provider. There have been very, very few examples of blockchain-enabled securitizations to date. Moody's has, however, worked on one such deal. In February 2019, the private equity group Weinberg Capital used blockchain technology to support an asset-backed commercial paper transaction. Moody's determined that the use of the technology would not result in a downgrading or removal of the rating it had already assigned to the notes. The idea of systemic risks stemming from blockchain adoption is not new. The European Banking Authority, a regulatory body, published a report in July 2018 that highlighted the potential for concentration risk arising from multiple institutions relying on the same blockchain provider. Quote, leading to macroprudential concerns, i.e., a possible single point of failure. The crux of the issue is the idea that a blockchain, to use Cerveni's words, is not a system that can run, quote, in autopilot mode, despite the technology's ideological origins and the desire for a currency free of the control of a central monetary authority. Quote, someone has to define the rules and also has to monitor the application of the rules, Cerveni said. Yeah, and there's two comments. We're going to go with the longer of the two. Gary Miller. We really shouldn't assess the future potential of a technology tool based upon where it is today. One must balance any futuristic vision with the reality of the times and take things in steps. The idea that securitization could run in some automatic way without the oversight of a control party, such as a trustee, at least at the institutional level, is a long way off, if ever. Not to oversimplify, but I cannot recall concerns in the past about a, quote, concentration of technology surrounding the use of Excel or Intex. One step at a time, folks. Yeah. Oh, and Paul says, yeah, well, you can't cook the books with a blockchain. Yeah, that's a bunch of bullshit, Paul. They've had editable blockchains since, I think, Accenture did it back in 2015. So, yeah, there is still plenty of systemic risk in quote-unquote blockchain, especially if you don't have the public mining it. You know, the trustless component is earned from the fact that it is an open network with an open ledger that anyone can participate in the mining of. When you take that component out of it, all of a sudden you're back in Trustville because you are trusting that the one arbiter, the one manager of the ledger is doing so faithfully and in your best interest. Now, I want you to think about it. When has anybody, but save maybe your parents, okay, seen to your best interests to the level that you would were it in your hands? Probably not that many. I mean, a lot of brokers out there have lost a lot of money for a lot of people. And so that implicit trust, you know, it's a hard thing to earn and an easy thing to lose. And once it's lost, it's pretty much lost. But you don't have to do that level of trust anymore. And I think that's one of the problems that a lot of these institutions face, is that they're unwilling to do the work, but they want to enjoy all of the trust without actually trusting anybody else. You know, they don't want to trust that you're going to mine the blockchain in their best interest. And you're probably not. You're probably going to be doing it in your best interest. But consider, and this is something Moody should consider too, it is in your best interests to play by the fucking rules and do the fucking work. Why? Why is it in your best interest to make sure everybody's transactions gets through on time, everybody gets the money right? Why is that in your best interest? Because if you don't do it, if the system that you are managing and marshalling is manipulating shit in the background and fucking people out of money, they are going to know about it. Not only are they going to know about it, they're also going to withdraw their trust from you and take their monetary value elsewhere. They will trust another coin. They will trust another system enough to move some monetary value from point A to point B, and it won't be you. Because you have abused your position and you have lost that trust. This is something that these people just they don't think about when they're talking about cryptocurrencies or blockchain. A blockchain without public miners is a distributed database. Consider, you can do all kinds of fuckery with a centralized private database that you're managing all the nodes on. You know, you can keep several series of records for different people, for different entities. Like you give one copy to the federal government, you give one copy to your state government, you give one copy to your customers, and you give another copy to potential investors. It'll all have maybe the same values, but just rebalanced to where it looks better for that particular sector of group. You know, that you're tailoring the data for your audience. And that's what Moody's is talking about with the systemic risk for structured finance. Is again that once you get off of the public blockchain and into somebody else's system, they have your money. It's no longer in your hands. And so all of the trust that you walked away from with your fiat currency is now resumed in your cryptocurrency. And you know, it sounds like I'm being hypercritical, but I use Bittrex all the time. I use Coinbase sometimes. When I can avoid it, I use other services. Just because they're way too expensive. Yeah, big whoop-de-doo that they're good, and they actually do get it done. They're way too expensive. There are cryptocurrencies out there with transaction fees under a penny. Why it should cost $30 for Coinbase to do anything it's just unreasonable. If it takes them a fraction of a penny to do a transaction, it should only cost you about 5 or 6 pennies to do that transaction. And even then, they're making a shit ton of money. But no, they're hyper greedy. And not only that though, a lot of the regulatory requirements that have been placed on them, like they actually have a bit license, which means they had to hire all of the compliance crew that particular licensure requires. And all of those people require money. And so that adds to the cost of the services that Coinbase can provide. In the longer term, that's going to be a real risk for them. That they're going to be telling people, yeah, we're going to need, $30 for that transaction. And people are going to say, okay, I'm going to withdraw all of my money from this account and put it in this other account over here, because they only charge me 5 or 10 cents for a transaction, not $30. And I don't care that they're not compliant. And I don't care that they're not paying all the regulatory compliance monkeys that you got running around that you have to have just to get that piece of paper out of the NYDFS. I don't care. What will be important to me is that they faithfully complete the transaction. That's it. Anyway, continuing on. I got this other thing here, and I talk a lot about stable coins, and it's mostly because I don't believe that their peg, the principal reason for having a quote-unquote stable coin is possible. I don't believe it is possible. Period. You cannot peg a cryptocurrency to the value of a fiat currency. And I've detailed why multiple times. But anyway, continuing on. I got this article here on BitcoinExchangeGuide.com, all one word. Is the crypto market saturated with stablecoin offerings? A closer look into the fiat-pegged tokens. And this is by Shiraz J. And let's do a quick check and verify here. Come on, Shiraz. Author. Yes, penis. Okay, had to figure that one out. And this is authored on April 29th, 2019. Even though the crypto sector has made a recovery of sorts over the course of the past 24 to 48 hours, News of recent Tether scandal has continued to dominate the global news cycle, as well as affect the price of many premier digital currencies in a negative manner. For those of our readers who might not be aware of this recent development, it has come to light that popular crypto exchange Bitfinex recently made use of Tether USDT tokens to mask nearly $850 million worth of funds that had previously gone missing from the company's coffers. In this regard, it should be clearly noted that over the course of the last 180 days or so, a number of different stablecoin projects have emerged onto the scene, primarily because the niche asset class has attracted the attention of a number of cryptocurrency developers and startup investors. If that wasn't enough, many rumors circulating across the internet recently have claimed that even social media giant Facebook is all set to enter the altcoin sector by issuing its very own messaging-based stablecoin. With all of this information out there, we need to ask ourselves the question, quote, are stablecoins already on the verge of being completely saturated? They were way saturated after Tether. A closer look at the situation. As many of our readers may already know, Tether's USDT is a leading industry stablecoin that currently has the 8th largest market capitalization of all crypto assets available for purchase today. However, in the wake of the aforementioned scandal, it now appears as though USDT is losing some of its clout and other competitors are eating at the premier altcoin's market share. As the rise in the number of stablecoin projects can also be seen as a response to the price volatility and valuation shift that was experienced by the digital currency sector all through last year. In this regard, it should be noted that while stablecoins don't offer traders with the same speculative abilities like other altcoins do, they do offer them with the advantage of pegged valuations, which in theory provide investors with more market stability. Owing to the unique framework that most stablecoin offerings make use of, many big-time players such as Facebook and JP Morgan Chase too are looking to harness the benefits of this burgeoning asset class. In the case of Facebook, the company is looking to deploy a currency, stablecoin, that can be used as a medium of exchange for its users, without them having to incur a lot of day-to-day price fluctuations. Yeah, whatever. That's not possible. Is the saturation already beginning to set in? As mentioned earlier, one of the main drawbacks associated with stablecoins right now is that they are fast becoming a saturated commodity. And while the crypto sector is far from having reached its full potential, with a company like Facebook entering into the stablecoin domain, we should ask ourselves the question, quote, how many stablecoins do we really need in this day and age? If certain reports are to be believed, Facecoin, the reported name for Facebook's upcoming token offering, will run primarily via the firm's WhatsApp messaging service. However, as more and more stablecoin projects continue to crop up, they will most definitely clog up the market and leave little to no room for differentiation. Final take. In closing out this piece, we should also point out that traditional altcoins such as Bitcoin and Ethereum have been designed to allow their owners to speculate on the value and usability. In this regard, stablecoins have a much narrower field of operation. Other than the fact that one project may be older than the other or might be associated with some big-name company. Also, stablecoins have very little ability to appreciate or change in value with investment. It is most likely that their market demand their market demand will remain limited over time. Yeah, I pretty much agree with that sentiment that there's no real utility for a stablecoin outside of being the stablecoin operator. I mean, there's the potential for making money on the arbitrage between your stablecoin and, whatever cryptocurrencies we're talking about, whether it's Bitcoin or Ripple or something else. Oh, that's interesting. Check that out. But anyway, stablecoins, as far as I'm concerned, you cannot peg the value of a coin, any coin, to the value of a fiat currency. And the reason being is that while you might know all of the little factors behind your coin, how many there are in existence, what your rate of issuance is, how many there will ever be, you might know all of these things. But you do not know all of these things for what you're trying to peg it to. You do not know how many Federal Reserve notes there are in existence. You do not know their issuance rate, and you do not know how many there are in savings or like I said, in circulation. You don't know how many there are. And so how can you appropriately peg the value of one thing that you know with something that you don't know? All you can do is have a spot valuation. And maintaining that spot valuation at a consistent $1 valuation is beyond your capability. People talk about the shortfall with regard to Tether in their books. It could just as easily be attributed to the fact that they're losing money on their fucking stablecoin. They're losing money trying to manipulate the market to maintain that dollar peg. It's clear that they don't have US dollars to back all of their stablecoins 1-to-1. And as a matter of fact, I don't believe any of them actually do. I will say that some of them probably have a higher liquidity threshold than a traditional bank, a legacy bank. Those probably only have 100th, maybe 1,000th of the liquidity that they're claiming to be able to collateralize obligations for. And I think that's really a big hit on the trust of banks, that you can take $900 million out of iFinex's portfolio and they can still function. Even if they are operating on fractional reserve, they have to have liquidity. They have to have collateral of some sort. Whether or not their debtors actually make good on their payments or whatever, that's yet to be seen. But again, we're back into Trustville. Everybody's got to pay off in order for it to work, at least as it's been described. And so I got this other article here, and I wanted to check and verify to make sure it's not from another place. And I think it might actually be. Let's see here. Action required. Yeah, whatever. This is relatively recent. It was April 17th, 2019. Tether USDT and Gemini's dollar GUSD both see rejection for the neutral dollar project. And this is by Bitcoin Exchange Guide News Team, April 17th, 2019. Is there a name associated with that? No. Alright. The neutral dollar project describes itself as a superior digital dollar, according to the platform. Quote, by aggregating a basket of other stablecoins, the neutral dollar generates a lower volatility token with a more subdued risk profile than any individual stablecoin today. Though there are many offerings in the platform's basket, it seems that Tether and Gemini have been removed. The platform shared with Crypto Briefing that neither GUSD nor Tether comports with the platform's requirements for being included in the basket. The platform is backed by 4 stablecoins at this point, which includes Circle USDC, i.e. Goldman Coin, Pax, True USD, and DAI, or DAI. Yeah, DAI. According to Matthew Branton, the platform's CTO, a combination of these 4 tokens provides an asset with superior value. He shared in an email with Crypto Briefing, quote, "Robust testing illustrated that by combining these particular stablecoins together, we reduce the overall risk exposure to one individual coin's volatility and can produce a superior token that is the most stable." As for the lack of inclusion concerning USDT and GUSD, he stated, quote, "Our testing found that the inclusion of GUSD and USDT did not procure diversification or liquidity benefits at this stage. The platform is focused on providing its users with transparency. Those who use the platform can redeem their tokens for stablecoins at any time. It is possible that the issue with GUSD and USDT is that they have never been audited by a professional firm. Actually, none of them have had a real audit by a professional firm. They've had attestations, but they've never had audits." This mistake is going to bite somebody in the ass. The inability to discern between an attestation and an audit is going to bite somebody in the ass big time. If you know you're going to create what is effectively a counterfeit fiat currency, you have to do a little bit of structuring beforehand. And some of it you can spoof with just editing timestamps and whatnot. But for the most part, you have to have at least 6 months of continuous documentation of the funds that are collateralizing your currency. You might be able to spoof the other 6 months, or you might be able to fudge it with reporting requirements. Because reporting requirement windows can be extended as far as 180 days. That might give you another 6 months of operation without the feds or somebody else breaking down your doors. However, all of this is meant for structuring, i.e. creating the impression of realities that are not real. And so what you do is, again, you have to have access to the funds at one point. Because you do have to have the funds in one place for the attester to be able to legally write off on a report that says at 12 a.m. or 12 p.m. Eastern Standard Time, Goldman Sachs coin had $12.5 billion in its accounts that are set aside or sequestered to be collateral for its USDC token. The attester has to be able to say that. The auditor, if you actually do have an audit, has to be able to say that. That according to all the records that they've reviewed and according to all the reports that they've read, the funds are yours. They're unencumbered by any other asset association or expectation, and that those funds are sequestered and held in trust as collateral to back your coin 1-to-1. That's what the attester or auditor has to be able to say. And, as the last financial crisis showed us, the people that are doing the reports, they can be bribed too. The mere pressure that they might not receive any more requests to do audits or attestations if they're too harsh, that's a real risk for them. And so, of course, they're probably going to take that into account when they give their report. And I've read those attestations. I've read them on this show. And if you're a lawyer, you can see the vast gaps in the reports themselves where the attester will not say specific things because they are not true. But enough of it'll pass muster, language-wise, that it'll pass the smell test. But again, attestations are not audits. They're the one person coming in, looking at the books and saying, yep, this is, at this time, this is legit. And like I said before, 6 months is structuring. You just put the funds in an account for 6 months, and maybe it's listed as something else somewhere else, but you just don't tell anybody. And everything will pass muster. Be like, yep, that's an account in your name, or that's an account that you have legal access to. Those are funds that you can legally tap into. And those are your funds and nobody else's. That's all they have to be able to say at that time. Yeah. Anyway, this is among the systemic risks that they were talking about in Moody's report, is that there's no guarantee with regard to the liquidity backing any of these stable coins or a lot of other projects in this space. And so, yeah, systemic risk all the way around, central points of failure all the way around. It's why Bitcoin exists. It's why cryptocurrencies exist. And we simply do not have to endure that level of risk anymore. Trying to get the same thing that you had in those risky elements out of these less risky elements by reintroducing the risk is just stupid. It's just stupid. You're not going to get enough benefit out of reintroducing the doubt in the integrity of your portfolio or your economy at large by reintroducing risks that you don't have to. And I think in the longer term we're going to find that out. That these regulators with all of their AML, KYC, know the color of your poop requirements are going to put enough people at risk, and that risk is actually going to prove real. Meaning that somebody who's having to retain all these records, a Goldman Sachs or somebody else like that, gets hacked. A decade worth of financial data gets leaked and sold on the black market, and people's portfolios are wrecked. Their identification is wrecked. It's only going to have to happen once for us to understand that keeping all those little bits of data in big old pile for somebody to come along and try and snatch creates more risks than it's actually worth. I mean, if the Marriott hack, I'm really surprised I have not heard more about that. That one should have been like on 60 Minutes or something like that. Marriott was being hacked for 4 years. Their records were being compromised for 4 years before they got any idea that it was happening. And 800 million customers had their data fucking swiped during that 4-year period. Do a little math. There's only 8 billion people on this planet. 800 million, 8 billion. Think about it. You're only off by 1 decimal point there. That's 1 out of 10 people got their shit compromised over a 4-year period because Marriott doesn't know how to protect the data. They just know how to gather it. That's one of the big problems about the Patriot Act and the requirement for total informational awareness is that they just required that the information be gathered and that some effort be put towards securing it. But the focus wasn't on securing it. It was on gathering it. And because of that, people have written their software with that priority, a higher priority on gathering it than securing it. Anyway, let's go ahead and throw back down into some music. And as far as where to go, man, I got Strapping Young Lad playing. I might actually play some of that during the next music break, or this music break. But I think this is more appropriate. Motorhead, Ace of Spades, here on Coin Metal. Oh man, as much as I love that song, it's Fear Factory Power Shifter. I can't let it play on. It's 10:54, and it is about that time, folks. I'm going to go ahead and close this episode out. Thank you very, very much for listening. I certainly do appreciate the support. We will be back again on Wednesday at 8 p.m. Pacific Standard Time, and so until then, I want y'all to trade safe. Do your homework. And watch out for your own bunghole, because nobody else is going to do it for you. Thank you again for listening, and y'all have an excellent evening. As far as our last dance goes, of course I have not picked it out. But I'm going to go with this one. Gizmachi, Wandering Eyes, Last Dance, here on Coin Metal. Thank you again for listening, and y'all have a good night.